Rewards cards are everywhere. Take your pick of points, miles, or cash back. 7 in 10 Americans carry one right now. And for most of them, it's the first thing they reach for when making a purchase. 2 in 3 say that the rewards are the reason. It doesn't matter if yours has no annual fee or it's a pricey luxury card with a fee north of $500. To you, they've always worked the exact same way at checkout. That's about to change. A 21-year legal battle between merchants and the two biggest card networks, Visa and MasterCard, just reached a settlement. The biggest antitrust case of its kind in US history. To understand what that actually means for your card and your shopping habits, here's something most people probably know, but don't think too much about. Merchants pay a swipe fee every time you tap or swipe your card. Here's how that fee breaks down on the back end. Let's say you buy a $100 pair of shoes. You tap your card. Before that $100 ever reaches the store, 3 parties take a cut. The payment processor, that's something like Square, Stripe, Toast, whoever the merchant uses. They initiate the transaction and settle the funds. For a small to medium-sized business, it typically runs somewhere between 0.2% and 0.5%, plus 10 to 20 cents per swipe. For this example, let's take the midpoint, 0.35% plus 15 cents. That ends up being 50 cents. Next, Visa or MasterCard. They're the network, the rails that let a terminal in Austin ask a bank in Delaware whether you're good for $100 and get that answer back in under 2 seconds. This fee is called an assessment, and it varies slightly between networks. Visa's is a flat 0.14% of the transaction, so on that same sale, that's 14 cents. Finally, the issuing bank, Chase, Capital One, Citi, Wells Fargo, whoever's name is on the card. They fronted the $100. If you never pay it back, that's their loss. They handle fraud, disputes, customer service, and they fund your rewards. For all of that, they collect interchange. This is the fee at the center of the 21-year lawsuit, and it's not a simple number. It changes based on a whole host of factors, including one where merchants have zero control over, which card you choose to pay with. For a basic rewards card at a small to medium-sized retail business, Visa's published rate is 1.65% plus 10 cents. That brings it to $1.75. MasterCard's rates run in a similar range. We're sticking with Visa's specific numbers throughout just to keep one consistent example. In the end, the merchant keeps $97.61 of your $100. But here's the thing. That's based on the cheapest tier card in the category. If you paid with a luxury card, something like the Sapphire Reserve, the rate climbs to 2.3%. And if it was purchased on a business card, the rate could reach 2.5% or more. The merchant's actual take-home depends on the card that's used to make the purchase. And until this settlement gets finalized, the merchant has no say in it. A rule called honor all cards means if a store accepts Visa, it has to accept every Visa. No exceptions. The merchant essentially finds out how much they pay in fees after the purchase has already been made. Visa gives its biggest merchants a volume discount most businesses never see. Qualify for it, and qualifying takes billions of dollars a year in Visa volume, Walmart territory. And that same rewards card drops to around 1.43% instead of 1.65%. A small edge, but it's on every transaction, billions of times a year. Now, flip it around. Take a local coffee shop and a $5 latte instead of a $100 pair of shoes. At the standard rate, that 10-cent flat fee alone eats 2% of the sale. The effective rate climbs to almost 3.5%. Visa actually built a fix for this. A special small transaction pricing tier that strips the flat fee out on tickets under $15. But most small businesses run on processors like Square or Toast. Simple flat rate pricing built for ease, not savings. That fix never reaches them. In 2025, Visa and MasterCard credit card swipe fees, meaning all of the fees combined, came to $118.8 billion. The year before, $111.2 billion. Up almost 6% in a single year, and up 80% since the pandemic. For the average American family, that works out to more than $1,200 a year in higher prices, and the rate keeps climbing. In 2010, the average Visa and MasterCard credit rate was 2.02%. Today, it's 2.36%. The lawsuit was filed in 2005, but the fee it was supposed to fix went up every year the case sat in court. So, what did 21 years of litigation actually produce? Let's look at what was signed. Merchants sued Visa and MasterCard with the claim that the fee for accepting cards wasn't set by competition. It was set centrally, by the networks, for every bank in the system, and honor all cards meant no merchant could ever say no to any piece of it without opting out of the network completely. 21 years and one rejected settlement later, a judge granted preliminary approval to this one. There are 4 key changes. 2 of them are minor. Average interchange drops by 0.1% and are capped at the posted rate for 5 years. And basic tier cards get capped at 1.25% for 8 years, which barely moves the needle, since only about 10% of Visa and MasterCard consumer cards fall into that basic tier category to begin with. Now, the 2 changes that visibly affect consumers. Cards will get sorted into 3 categories: standard consumer, premium consumer, and commercial. Premium here doesn't just mean the luxury metal travel cards with lounge access. It's a specific list of network tiers. The easiest way to tell if your card falls into the premium category is to look for it on the card. For Visa, if you see Signature or Infinite, then it qualifies. For MasterCard, look for World, World Elite, or World Legend. One payments industry source estimate published recently puts these premium cards at roughly 85% of all Visa and MasterCard consumer credit volume. Here's why that categorization is going to matter. The last key point in the settlement is that merchants can now reject an entire category or a specific product, choose to selectively surcharge up to 3%, or offer a discount to those paying with a lower fee method, effectively doing away with honor all cards. Just keep in mind that at the time of recording, none of this is finalized yet. There's an objection period, a follow-up hearing, and further appeal is considered likely. It could be 2029 before any of this fully takes effect. Projections estimate the settlement will save merchants $38 billion over the next 5 years, but that number only counts the rate cut. In theory, merchants should save even more than that, since they're no longer forced to absorb the cost of accepting expensive premium cards at all. So does that mean prices go down? J.D. Power found that about 1/3 of merchants already surcharge credit card purchases. That leaves 2/3 who don't, who fold the fee into the shelf price instead, which means for most of your purchases, your rewards points have been quietly subsidized by everyone at the register. The person using a basic card, even the guy paying cash, helped pay for your flight that you redeemed with points. Until now, a rewards card had no downside at checkout. Same price as everyone, plus you earned something. That was the entire deal. Going forward, a merchant could refuse your card's category, or add up to 3% as a surcharge. 2% cash back, but have to pay 3% to use it? That's easy math. Points and miles make the math murkier, because their value moves depending on how you redeem them. A point could be worth 2 to 5 cents if transferred to an airline partner, but be worth half a cent if redeemed straight for a statement credit or gift card. So the real question a rewards player has to start asking at checkout isn't just which card will earn me the maximum number of points. It's also, will those points be worth more than what I'm about to get charged? That calculation didn't used to exist. It was a no-brainer to use the card because the fee was invisible, and merchants have very little reason to hold back. J.D. Power found that 81% of surcharged cardholders have switched payment methods at some point specifically to dodge the fee. That sounds like a risk for merchants, until you notice what switching actually means for them. A customer who swaps to debit or cash to avoid the surcharge doesn't cost the merchant the sale. They just cost the merchant less to process. Either the customer eats the fee, or the merchant's own cost drops. There's almost no version of this where the merchant loses. The customer is already standing there, already committed to the purchase, and walking away entirely is a much bigger decision than switching payment methods. So where does that leave the rewards game? That's the maze for anyone actually playing the points game. But most people aren't running that math at checkout. They just want to know one thing. Is any of this going to make stuff cheaper? Well, we don't have to guess. This experiment already happened. Back in 2011, the Durbin Amendment capped debit interchange, roughly cutting them by half. merchants got a real, permanent cut in what they paid. One survey, taken in the years right after the cap took effect, found that 77.2% of merchants changed no prices at all, 21.6% raised prices, and only 1.2% lowered them. Now, correlation isn't proof. We can't run the world twice and see what those same merchants would have charged without the fee cut, other costs, competition, the broader economy. All of that was moving too. But if consumers were already buying at the current price, there's no real incentive to change it. The only thing that might be changing is your default card. For years, rewards cards felt like free money, points, miles, or cash back just for using a card to pay for something you were already going to purchase. They were never free. They were funded every time anyone swiped a card, including the people who never earned a single point. This settlement doesn't dismantle that system. It doesn't lower your prices, and it may even raise them. With annual fees on cards like the Sapphire Reserve, now at a hefty $795, do you think that's still worth it? Or is the rewards game finally coming to an end? Let me know in the comments below. This settlement still has to survive an appeal, and one earlier version of this deal already collapsed before it got this far. If this one falls apart too, that's a very different video. I'll be watching it closely.